think every student has to master so that they can be good, okay, when it comes to dealing with tax in Ghana and even worldwide. These are the same rules, but every country's rules are different. For us, we must first understand deductions under our law, especially deductions that are allowed for tax purposes. Now, before we even go into deductions, I want us to go back to accounting. I know most of you, it's been long since you did accounting, but let's go back to the basics, right? And that is what will make you understand accounting very well, or tax accounting very well, right? So when we take the general financial statement of every company, because tax has to deal with profits, we take the profit and loss account, right? Or the statement of comprehensive income, or statement of profit or loss, another comprehensive income, or statement of realized income, as they call it in the UK, statement of profit and loss, trading profit and loss account. It can also be called the income statement, right? So when we take the basic income statement of a company, okay, let me see. I mostly like this purple color. So when we take the P&L of every company, how does it look like? We start with sales, not so. No, be so. True or false?
Now, so
So we start with the sales of the company. Then we less what? What do we take?
cost of
We take the cost,
Cost of
right? Okay. So cost of sales, we know cost of sales is made up of what? Opening
opening inventory,
okay. Then we add what?
purchases.
Add purchases, okay. Then we add what? Other direct expenses, not so. No, be so. People are not used to this. Any direct expenses also includes purchases, right? Like the purchases, maybe there'll be transport, true or false? Non-refundable,
True.
right? Maybe VAT, NHIL. You know, NHIL, you cannot claim it, right? They are all part of our cost of sales. I'm telling you this because most of the time, the questions we'll be dealing with are merchandise entities. Today, the question that we are going to deal with is very loaded. It's a merchandise entity. And one thing you must understand is that when it comes to your exam, okay, we focus most of the time when it comes to dealing with allowable expenses or corporate tax liabilities, okay, is that most of the time they are going to give you this type of question. Either you are dealing with a manufacturing, okay, a manufacturing or merchandise entity. What's the difference between a manufacturing and merchandise entity? You can tell me the difference. What's the difference between a manufacturing entity and a merchandise entity? Yes. Well, I'm listening. What's the difference between manufacturing or merchandise entity? Yes. Nobody is talking now. Manufacturing and merchandise entity. What's the difference between the two? Hmm? Oh, my people. Manufacturing and merchandise entity.
Okay, let me try.
Okay, sure.
So the merchandise company normally buys finished products and resells them to final consumers.
Sure.
While the manufacturing company, they buy raw materials, then the materials to finished goods and sell.
That is true. Okay. So manufacturing companies manufacture and sell, and merchandise entities actually buy to resell. So it's actually the distribution chain, right? And that is why when you are learning how to even compute taxes, you need to know the distribution chain. It starts from what? The manufacturer and also, which you must know how to account for, then goes to the wholesaler and also, then the wholesaler goes to who? The retailer and also, then comes to what? The end customer. Is that not so? But then each of these people might be businesses on their own, true or false? And we must know how to account for these guys because when it comes to the manufacturer, he's going to have production costs. Remember, His cost of sales will be cost of production. Do you get it? Because he produces to sell. Please, do you get the mechanics? Hello? Do we all
Hi.
mechanics?
Yes, sir.
Because a manufacturer will manufacture to sell. So his cost of sales will have what? The manufacturer will have what? Opening stock of what? Raw materials, not so. Then there will be what? Some purchases of raw materials that he had, right? Of raw materials that he had. Then there will be what? Closing stock of raw materials that he has left, right? So this and this gives us the one available for production. You take out what was left. That gives you what? The raw material consumed, right? During the period. Then there will be labor cost, okay? There will be labor cost. There will be other factory overheads, right? There will be other overheads that were used in production also. Now, these are all the production costs that this guy will incur, right? Which is actually his cost of sales because he produces to sell, right? How is this different from merchandise entity? With merchandise entity, he doesn't have this. All these things plus a margin will be given to him. And that is what will go into his purchases. Do you understand? So these people buy to resell, right? That is why we call them purchases of inventory. And these people just what? Manufacture, I get it. And then they what? They sell to these people, right? Now you need to understand this to understand what the tax law allows you, because most of these things are deductions. What the tax law allows you to deduct and what the tax law does not allow you to deduct. Now in accounting, we realize one thing, that after your gross profit, don't we add other income? Do you remember?
Yes.
Yes, we add other income. And this income may include things like what? Rent received, right? So let's add something like rent received. We may have what? Dividend what? Dividend received. We may have investment income. Let's say interest received also. Interest received. Okay, so once we have this, that's the gross adjusted gross profit. Then we less what? What then do we take out of this? Is it not expenses, operating expenses? Do you remember? We are just going basic accounting. I want to explain something to you. Okay, operating expenses. So operating expenses, let's start with common ones. Wages and salaries, right? So wages and salaries, everybody, you must pay people. Rent, right? Rent expense. The business must pay utilities. Not be so. Then what else should we consider?
Depreciation.
Depreciation. Bad debt, right? By all means, there are going to be some bad debts. Foreign currency losses, foreign exchange loss, foreign exchange losses, loss on disposal of assets. There are so many expenses, right? Fees, fines, penalties, they are all going to be taken out, right? So expenses that businesses incur, right? So when you deduct all these ones, you are now going to have your operating profit also. You're going to have your operating profit. And this operating profit, now you can deduct your interest expense from this also. Your interest expense, or what we call the cost of finance. So you take out your interest expense, then you get your profit before what? Profit before tax, also. Then after profit before tax, you deduct what? Your tax expense, right? And this tax expense is a provision, right? And remember, when you are doing tax, I'll come and explain tax accounting rules. When you are doing tax, this tax that you see on your financial statement is not accepted by the tax law, right? Why? Because this tax is based on an estimate. Do you understand? Which is dealt with under IAS 12, your current tax and deferred tax provision. Actually, this tax is made up of three things, okay? So you can use CUD. Okay, so it is made up of your current tax provision, which is what the tax law sort of allows. Then we have what we call under or over provisions, which is whether your previous tax exceeds what you anticipated. Then we have deferred tax movements, right? So the tax that you see on anybody's financial statement is not the tax that the tax law accepts, right? If possible, if it is only this one, sometimes it could be closer, right? Because when you file your returns in the next 4 months after the year end, it could be the same thing that your provision, if it doesn't exceed what will actually be given during a provisional, right? And then you come and get your profit after tax, right? But one thing that we must all understand is that even in normal accounting rules, when we buy assets, non-current assets, do we charge them to the P&L?
No.
When we buy non-current assets, do we charge them to the P&L?
No.
No, we don't. They go to the balance sheet. Is that not so? And because they go to the balance sheet, it means that even in tax, remember, tax is still accounting. Even in tax, we do not accept that. So there's two principles I want you to understand. The principle of allowing expenditure, right? Allow and disallow. Okay. Now, you see these deductions that this guy has done, the wages and salaries, all these things that he has done. If the tax law says that, okay, these wages and salaries, it is wholly, exclusively, and necessarily incurred, I'll come and explain what that means. It means that all the expense is really required for your business, right? If the expense is required for your business and the whole amount is required for your business or is necessary for the operation of your business, then we allow. Allowing means that this deduction that you have made, we don't touch it. We allow it as it is. We allow your accounting. So allowing means allow the accounting that the person has done, right? So allow the accounting done by Mr. Johnson. So if Mr. Johnson has deducted wages and salaries, should we allow his accounting? That is what allow means. So assuming this rent expense that Johnson has, right? Half of the premises was his private premises. Let's say the rent he was paying was 120,000. Should we allow all his accounting or we should disallow part? Should we allow the accounting or we should disallow part? Disallow means reverse it. Do you get the rule? Do you get the rule? So
Yes, sir.
he's using half of the premises for his private residence, and we're only dealing with business expenses. So should we allow all the 120,000 as a deduction?
No.
No.
We must reverse half of it, right? When you reverse it,
Yes.
what? You are making it what? Go back to zero. So this is what happens. You see our profit after tax that we have down there includes all these expenses which have been deducted, right? So if this was minus, to make it zero, don't we have to add this to it, right? So if you have minus 5,
Yeah.
you have to add 5 to it to make it zero. True or false?
True.
So when we say reverse it, it means that we start from the profit and add back, are you getting it? The expense you are disallowing. So the rent will add what? 60,000 rent back because we have already taken 120,000 here as a deduction. When we add 60 back, in effect, it is only 60,000 that we show, which is half of the 120. Do you get it? So adding back means you are reversing the accounting that the person did. I hope that makes sense. And it is not any expense like the bad debt, the depreciation, the things you are seeing. It is not all of them that have to be allowed as deductions, right? So we have to look at what the tax law has for us, what we can deduct as deductions and what we cannot deduct as deductions. So you will do your normal accounting, right? You will do your normal accounting and say that, okay, I've deducted all these ones. But the commissioners may say, hey, Chairman, watch out. It's not everything you have deducted that I will allow. Do you understand? So I told you allowing means allow the accountant, do not touch it. Disallowing means what? Reverse the accounting the person did. Does that make sense? Are we all okay now?
Yes.
Okay, so now let's go and see the rule that govern outgoings and expenses, right? So what are outgoings and expenses? This means amounts that have been actually paid out of the business. I get it. And paid by the business, by the person or business, and yet to be paid, right? So it could be paid or paid. Are we okay? It could be paid or yet to be paid. And why yet to be paid? We are talking about accrual here. Okay, tax, remember I told you we are doing tax accounting. Tax still goes with accounting. So it means that the expense could have been due for a period, right? And that is the concept of what? Matching, okay? Matching. Once you incur revenue, there might be a corresponding what? Expense that comes with the revenue. So you must match all expenses to its corresponding revenues during the year. And there's the principle of accrual that we report income and expenses when they are earned or due and not when cash is received or paid, right? So tax still applies the same principle. Please, is it okay? So remember this. Now, while some expenses may have been paid, others do not involve cash payment, but are only acknowledgement of liabilities payable in the future or without the need for any payment or cash or cash equivalents. It must be noted that not all expenses incurred in the course of trading are deductible in computing profit or gains for tax purposes, right? So yes, you have done your deduction for accounting purposes, but the thing is, will the Commissioner General allow you to deduct it, or he will what? Reverse it, which means he will disallow, right? You just understood those principles. Now we have to understand the principle of capital and revenue expenditure. Now, what is capital expenditure? Capital expenditure refers to the spending of funds on assets that are expected to provide benefits for the business over multiple years or benefits more than a year, right? So these are investments in assets that are not consumed immediately, but are used to generate revenue over an extended period. So when we talk about capital expenditure, purchasing property, plant and equipment, I get to constructing a building, making substantial improvement to existing assets, they are all considered capital expenditure. And we all know from accounting that all capital expenditure should hit the balance sheet, right? The statement of financial position. But it depends on something we call materiality. So what is materiality? An item is said to be material if its omission or misstatement, are you getting it, is going to influence the decision taken by the end user. So we are saying that things that are material have predictive value and confirmatory value. It means that once that thing happens, right, you could tell that, okay, this thing is dire, it can easily collapse the business, or this thing can really affect a decision somebody is taking in the future. Are we okay? So we are saying that, okay, look, let's take a hammer. How much is hammer? Hammer is 80 cedis, right? Okay. Now, hammer can last more than 20 years. No be so. So will we consider this a non-current asset? Please answer me. Hammer is 80 cedis, right? But because of the nature of how hammer is, it can last for multiple years. Does that mean hammer is a non-current asset? Oh, nobody is talking.
No.
Why? Why is it not a non-current asset? Because hammer can last for 20 years, even 50 years, and nothing will happen if it is kept well. Why?
The amount.
Thank you. So though we say that, oh, capital expenditure are things that what last for more than an accounting year, but you also have to look at the materiality, okay? For instance, somebody may have a vehicle worth 20,000. Is this material? Yes, for a small business, right? 20,000 is huge for a small business. True or false? True or false?
True.
Now,
True.
look at a mining company with revenue of 40 billion Ghana cedis. Is this material? Is this something that they have to capitalize?
No.
No.
It is very small, right? It is very small compared to their revenue. So I'm telling you that the tax you are learning is also accounting, right? You don't just say, oh, this one secures a benefit. I had an encounter with some tax auditors, and it seems they didn't really understand materiality. So they'll tell you, why did you expense this? Add it back. And I'm saying, Masa, this thing, the company's asset base are over 400 million Ghana cedis. And you are telling me to add back 10,000 cedis. Really? Doesn't make sense. This 10,000 cedis needs to be expensed. 400 million compared with 10,000. Please, let's do the calculation and let's see something. Let's do the calculation. What percentage is that? Calculate it for me. The calculator cannot even think, right? Eh? Oh, do the calculation for me.
0.000025.
So it tells you this is so immaterial to the account. But because the rules that they lent is it secures a benefit more than 1 year, add it back. No. A small signboard costing 10,000 for adverts, and they have multiple ones. So why should I add this back? Do you get what I'm trying to say? These are the principles I want you guys to get as tax practitioners.
So, Jill, how do you recognize it in the income statement?
You expense it. Compared to the revenue, you see, it is too small. It is too small to capitalize. Do you understand? So it's supposed to be expensed.
Okay.
I hope that is okay.
Okay.
It is supposed to be expensed. Now, I like us to even, before we look at the rules, let's take a pure question and let's see something. I want us to use our minds, go through the question and see if what the company is having is something we can do. Let's see something. I want us to see a big question, a very big question, very big one. This is Mamavi. Let's see Mamavi, right? Mamavi is a retail businesswoman with a chain of shops in Ghana. And she commenced business on somebody's background. Who is that? She commenced business on 1st March 2011, okay? With a business name of Unity Enterprise. She sells health foods, fruits, vegetables, and juices. The enterprise profit or loss account for the year has been given. So you see, we have Mamavi. Mamavi is an individual. She has her sales, opening inventory, purchases. It has a note, right? Closing inventory. Then she made some rent income. She earned some interest. Then she had promotion or entertainment. Do we allow or disallow based on what we just learned? Promotion or entertainment, do we allow or disallow?
Disallow.
We should disallow, but we don't know the details of what promotion or entertainment, right? Wages allowed, right? But we don't know whether she's paying herself or not. Do you understand? It could be that Mamavi is trying to pay her own self. Because, you know, when a sole proprietor ends up paying herself, we disallow it because at the end of the day, all the profits come back to you. Do you understand? So why would you pay yourself? That's what the tax law. What about electricity and water? Mostly should be bank payments. Why bank payments should be here? That is it interest? Because bank payments are simply cash items. Why are they here? Or bank charges should be allowed. Telephone, definitely, right? You need it. Depreciation, no. Bad debt, we don't know. But we don't allow bad debt unless they are specific, right? Rent, we have to check. Rates, there are rules. General bad debt. She has a lot of expenses. Insurance, legal and other sundry, right? Okay. Now look at something here. They are telling us that her purchases includes 2,200 in respect of goods that she took for her own use. She took some goods for her own use. And these goods have a profit on them. And so my people, if you take goods for your own use, what are we going to do? Somebody's background is noisy. I don't know who that is, but it's sort of disturbing the class. If you take goods for your own use, what are the issues around it? We haven't learned it, but I want to see how you are appreciating tax. You took goods for your own use, and then there's some sort of profit element on those goods. So what are we going to do with that? Yes. You took goods for your own use, and there's some sort of profit element on those goods. Oh, we are all learning. I will still teach you. So I want your idea. I assume you don't know anything, but for now, I assume you don't know anything yet. We've not learned it, but I just want your idea.
So this one, it's like drawings. So once there's profit on it, and then they have given us the markup, you have to find the cost and add back. Is it right?
And add it back. Okay. Okay. Any other? Any other? In 2018, she earned 1,005 for the rent of a holiday home in Ho, Volta region for the year. This is rental income. I'll come and teach you the rules around income. For now, I'm not concerned about income. Expenses. Promotion and entertainment. Golf lessons, should it be allowed?
No.
No.
Why?
That's his personal.
It's personal.
It's expensive. Okay. Christmas party.
And disallow.
Why?
It's not directly. It's not only and exclusively towards the business. So we have to take it out.
Advertising on health foods.
Should be allowed.
Okay. Because she sells.
Yeah.
Should be allowed.
Yes. We said that's the the nature of the business.
Yes, Habib.
Please, the Christmas party. And we cannot treat it as something allowable. Maybe it's part of the staff welfare, something that you are doing every year.
If that was the case, then fine. But this one, they just said promotion or entertainment. So they didn't give further details. So what we would do would be to disallow it. Do you all agree with me? Let's look at the wages. Dropped by Mamavi.
Disallowed.
Disallow.
I told you that sole proprietors, anything they take from their business, at the end of the day, the profit come back to you. So why are you drawing from it and charging it to the account, right? Do you understand? So, because at the end of the day, all the profit you make, doesn't it still come to Mamavi? Won't all the profits come to Mamavi?
Yes.
So if she's drawing from it and charging it to the account, should the commissioner accept that deduction?
No.
No, because at the end of the day, all that still comes to you. Now, what about staff wages? Allow?
Yes, allowed.
Yes, because you need to pay staff. Paying the babysitter to take care of Mama B's daughter, is it business required? Without this, can the business survive? The business will still survive, right? You don't need
Yes.
to take care of Mama B's daughter. Somebody will say, if Mama B is not taking care of her daughter, she cannot come to work. She cannot come to work. Huh? Tax payment on account for Mama B. She paid some taxes.
Right.
And you haven't learned that rule. I assume you haven't learned that rule now, so let's just ignore. I just want the basic ones which you can. Mama V pays electricity and water for her home and office, and 20% of the cost relates to her home.
Added back.
Water cost that we have paid, we have to disallow it.
Yes.
80%, right?
80%.
That means only 80% is business required. Okay, bank payment. She paid business loans and she paid mortgage loans. I get it. And they are saying that a business loan was taken out to finance the cost of improvement to the store, in particular the juice bars. The interest element included in the loan repayment amounted to 1,750. And a mortgage loan was taken out to buy the family a house in Plefi, Volta region. The interest element in the loan repayment for the mortgage was 2,670. So the thing is, bank payments are cash items. Though you paid, right? Is it the interest that they paid? This business loan repayment, is it the business that they paid or the loan itself? Is it the loan interest that was paid or is the loan itself? I'm just exposing you to the kind of questions you'll be getting. That's why I'm just starting with the questions so that you see what you are up against, so that you learn well. I'm asking, is it interest that is here, or it is the loan itself, the loan payment itself that we see?
The loan payment.
So loan payment, should it be allowed in the profit and loss account?
No.
It's only the interest element, right? And they are saying 20% of the telephone relates to private use. That means you have to take 20% away, right? And they say the rates, this includes 120 cedis in respect of local property tax for Mama V's home. The difference is business rates. So this one, that was local tax for her home. Does it belong here? Does it belong?
It doesn't belong to the business.
Okay. Insurance includes business premises insurance, allow, right? General business insurance, allow. But she has private medical insurance for her children. Should they be allowed? Should it be allowed?
No.
Legal and other fees. She paid accountancy fees to her accountant.
Yes, allowed.
Court case following a car accident.
Disallowed.
Allow or disallow?
Disallowed.
We have to read first though. Speeding fines. You could have avoided it, right? You went to speed and they fined. Disallow. But let's see. This court case was as a result of a car hitting Mamavi when she was walking her dog out at night. Hey, Mamavi, where are you going? A car hit her. Is she the one? Car hitting her. Okay, so she had to employ a lawyer, right? Okay, to take her money for it. The car owner claimed Mamavi stepped in front of him, and therefore it was her fault. Mamavi's lawyer told her to respond to the allegation because she needed 5 sessions of physiotherapy to help heal her leg. Mamavi is suing the car owner for her costs. So this court case that she went to pay 700 for legal fee. Are we supposed to allow or disallow?
Disallowed.
No Mamavi's fault now.
It has nothing to do with business.
It has nothing to do with business. They are not fair. They are not fair. Okay, then we have sundry. Painting. Painting is needed, right, for business. Juices and food processors for a shop, allowed. Advertising, allowed. Lease charges, allowed. Stationery, allowed. But it says 700 of the painting costs related to the painting of Mamavi's private house. The balance related to painting her shop. So 1,002 lease charges relate to the leasing of a car for the business. Allow or disallow? Also allowed, right?
Allowed.
I like the way you guys are just seeing the practicality of the thing. Now let's go back and let's understand the principles of deductions so that these things can be done well, right? Okay, so let's go back. Okay. So we looked at capital expenditure and we have come to a conclusion that it is not all capital expenditure that can be deducted, that can be capitalized, right? Some need to be expensed based on what? We talked about some principle. It is because of what principle?
Materiality.
Materiality. So because some things might secure a benefit for more than 1 year, but they may not be material in nature. Do you understand? What about revenue?
Sure.
Revenue expenditure, on the other hand, is the spending on your day-to-day operational expenses that are necessary to keep the business running. So these are costs that are incurred for short-term benefits and are usually consumed within the current accounting period. So wages, utilities, rent expenses, maintenance, other routine operational expenses are considered revenue expenditure. So things you do in your normal day-to-day, right? They are all termed revenue expenditure, right? Okay. Now let's look at the rule for deducting expenses. I taught you what allow and disallow, right? But let's understand the principle of residual deduction. So when we say residual deduction rule, okay, it is covered under what? Section 9. Now, for the purposes of ascertaining the income of a person for a basis period from any business or investment for year of assessment, a deduction shall be allowed to the extent that that expense is wholly, exclusively, and necessarily incurred by that person in the production of income for the investment or business during the year. It means that so far as you incurred an expense that was used to generate income from your business or investment, then that expense should be allowed if only it meets the when criteria. The expense must be wholly. That means the whole quantum or the whole quantity of the amount being charged should relate to the business, right? The amount should be wholly related to the income. When we talk about exclusively, exclusivity means that what? The purpose for which the expense was incurred, was it exclusive to your business? So the expense must be relevant to the operation of the business. They must have a bearing on the operation of the business for you to say that this expense is exclusive to the nature of your business or to the operation of your business. When it comes to necessarily, it connotes some form of compulsion on the taxpayer. is it inevitable? Can you do without that expense? Like Mamavi's daughter, the babysitter, can it be done without? Can the business go on without incurring that expense? Can the business go on
Yes.
without incurring that expense? Yes. So far as that can happen, it means that that expense is not what? It means that expense is not what? It's not
Necessary.
Not
Necessary.
necessary.
that is what you are looking at, right? For the residual deduction rule. So any expense which does not meet this is not allowable. And two, there are some non-deductible expenses that we also have to consider. So non-deductible expenses are expenses that are accounted for in the income statement of the taxpayer, but not accepted as a deduction in the tax laws. So it means that you can deduct from your normal accounting, right? But for the tax law, we won't accept it. So for example, any accountant will deduct depreciation and provision for bad debt from income when preparing financial statements. However, in the eye of the taxman, these expenses will not be treated as expenses that should reduce the income of the person for the year, because we want money to be taxed, right? We need revenue, and it is not every expense that should be allowed. So what are the categories or types of non-deductible expenses we may have? One, expenses which are not wholly, exclusively, and necessarily incurred should not be allowed. So an expense that does not meet the residual deduction rule is not deductible for tax purposes. Do you understand? We talked about the residual deduction rule. So we can explain the residual deduction rule in a simple terms. When we say an expense should be wholly, exclusively, and necessarily incurred, what does it mean? What does it mean for an expense to be wholly, exclusively, and necessarily incurred? Oh, I explained, or just explain the three for me. Wholly, exclusively, necessarily. Yes.
No, sir.
So when you say it's wholly, it means that the quantum of the amount you are spending must be directly related to the business.
Okay.
The whole amount.
Okay.
And then exclusively means that the expenditure should be tailored business and not for nothing else. So we should not have any private, we should not have any other thing, but it should be towards the business. And then the necessarily is that the expenditure must be incurred. Without it, the business will not be able to survive.
It's inevitable, right? It is necessary for the business. Without it, the business.
Yes.
Fine. Thank you. Right. So any expense that does not meet this residual deduction rule shouldn't be allowed. Do you understand? Two, any expense of capital
No,
nature.
sir. Please hold on.
Yes, go.
Please, can you explain the exclusively to me again?
Exclusive means it is particular to the business. Like, there are some expenses that are inherent to a particular business. For instance, every business needs to pay wages and salaries, for instance, right? Or every business needs to pay for utilities. These ones are required. They are exclusive to that business. Do you get it? Or some licensing fee that manufacturers pay in Ghana to be part of the Ghana Manufacturers Association. You see, this expense is exclusive to that business. Some other businesses may not have it, but it is necessary for the business and just attached to that business alone. It is inherent. Yeah, are you okay?
Yes, sir.
So when we say exclusive, we are talking about specific or particular to a particular business. Do you get it? So, for instance, with OMCs, there are some charges that they pay that allow them to operate as OMCs. Do you understand? It is part of that business. So, if you incur that expense, we could say it is particular to that business or exclusive to the operation of that business. Is everybody okay? Is everybody okay?
Yes, sir.
Now, two, expenses which we cannot deduct. Two, expense that is of capital nature. Any expense of capital nature is not deductible in determining the chargeable income of a person from investment or business. An expense is deemed to be of a capital nature if it secures a benefit that lasts for more than 12 months. And you remember that You remember that I told you something earlier. You remember that I told you something earlier regarding capital expenditure. Do you remember? And I said
Yeah,
it depends on what?
Materiality.
The materiality. So you don't say that, oh, this one secures a benefit more than 1 year. So because of that, it's of capital nature, like what the auditors did to me. That you just add it back. It doesn't work like that, right? You have to check the amount. Okay. Are you okay?
Yes, sir.
Okay. So what are some of the capital expenditure that you can consider to be small or not material, but may secure a benefit for more than a year?
Petty tools.
Petty tools. Like
Petty players and those players, those ones that are tools that are used in the course of work. They are collectively you use it to perform a task.
sure. That is true. Okay.
So dear,
Yes, boss.
under a mining industry like that, you were given an example. So even if we have computers, maybe worth 50,000 Ghana cedis, we shouldn't recognize as assets.
Sometimes they write them off unless they were incurred as part of a production pool, right? So for mining and petroleum,
Okay.
always according to, let's say, petroleum, right? We have what we call the exploration and what development expenses, right? Whether or not
Yes.
any petroleum capital expenditure, whether or not it's of capital nature, we put all into a single pool and that capital allowance at 20%. So it means that during the period you are buying those computers, if you sum all of them up, computers, cars, whatever, plant and equipment, we put all together and just charge all at 20%, right? But under normal circumstances, if this were not pre-pooled, then depending on the amount, they may be expense. Habib, is that okay?
Okay. Yes, dear, please. Thank you.
You're welcome. Okay, so let's look at domestic and excluded expenditure under section 130. Now, these expenses are not allowed. So what is domestic expenditure? One, domestic expenditure is your expenditure as an individual. So when you incur expenditure for your personal needs, like maintaining yourself, buying clothes, are you getting it, leaving your house, right? Acquiring clothes, except work-specific clothes that are required for you to work, which your employer may compensate you, or your employer might buy for you, right? Or non-business related education. Let's say that I am an accountant, right? No, so I operate an accounting firm. Then I go and learn sewing and I charge it to my account. Should it be allowed or disallowed? Should it be allowed or disallowed?
It's a,
Should it be allowed or disallowed? I'm running an accounting firm. Then I go and learn sewing, how to sew clothes. And I charge it to my account as an expense. Should it be allowed or disallowed?
it's allowed.
I heard allowed.
No.
Disallowed, right? Why? Why
Yeah.
should it be disallowed?
That's a private expenditure and has nothing to do, it has no direct impact on the business.
Okay, so what if
So you cannot add it.
if I go and do ICA, or I go and do CIT, or I go and do business development training? Those ones,
That is allowed.
Yes.
why should
The law allowed that.
why
That's
should we allow? Why should we allow that one?
Because you see, that relates to the what you are doing. That is professional in nature. It relates to this thing. You are going to use it
It should be disallowed.
doing. And it's not purely academic.
Next is like your voice.
So, the law allows you to add.
So we are saying that so far as it is business related education, right? It relates to what you are doing, then we should allow it because it is necessary for your business to grow, for your business to run, right?
I
But
said,
non-business
if you are
considered domestic expenditure.
Circle a question, please.
Yes, go.
Okay, so let's say so let's say the business is okay, somebody.
And then you go and
Can't hear anything, no, isn't it?
enhance it.
No, but
You
you
didn't do it. Enhance what you do. The section of the law should allow you. Yes.
And that's what I'm giving back.
the network, oh, I can't hear anything.
You can't hear anything.
Now I can hear. Now I can hear.
Okay. Okay. So okay. Let's say it's where the owner of the business decides to train his children to become doctors. Succession.
Okay.
Will it be an allowable expense or a disallowed expense?
Like he trained them within the work itself.
Yeah, in the medical specialty.
Personally,
If
education. You see, the law could have allowed it, but it should come with a certification. So they are saying that the place you are doing it itself should be certified to give that training. So if the hospital is certified to provide that training to their staff, right, to make them competent enough, then it should be allowed as a deduction, provided they can provide those certifications to outsiders and give them that certificate. Do you understand?
yes. Thank you.
Samuel.
Okay. His mic is muted. Okay, he's back. He's gone off again.
Alex, I don't know. I don't know whether it's the network. Is my network working as well? My network working?
No, so yours is okay.
But I don't know if you guys speak. I cannot hear anything. Alex, you just type for us. Type in the chat for us. I will see and respond. But I can't hear anything. I don't know. I can't hear anything. Anyway, let's go. So we've seen that when you incur your own private expenditure, right, it's considered domestic expense. Then when somebody incurs an expense on your behalf, right? So let's say that your employer provides you some benefits, okay, which is like something to be included in your income. You cannot include it in your business because somebody incurred it on your behalf, right? Except under specific conditions. I don't know who is speaking. I'm not hearing anything. Are we okay? So sometimes too, we can include an amount in your income which is small, too small to account for. An amount like 100 cedis, expensing it in your, you get it. This one like this, you can decide not to expense it in the first place. It's too small, depending on the nature of the account. Do you understand? I hope we are all clear. So that was domestic expenditure. Now, if you have interest, okay, you went to borrow an amount from your family member or from a friend or from somewhere, and you use it to incur this domestic expenditure. Let's say you went to borrow loan to buy clothes, or you went to borrow loan to, you know, maybe renovate your house. You cannot charge it to your business, right? So the expenditure should also include what interest incurred on borrowed amount used for those specified purposes. Then the interest should also be disallowed unless it went to a loan which was used to acquire an asset or was used to run your business. Then the interest on that loan will be allowed. I hope that is okay. So domestic expenditure also includes interest on loans that were used to what? Pursue or purchase or maybe incur those domestic expenditure. Please, is that okay? Are we okay? Are we okay?
Yes, sir.
Okay.
Now we've seen expenses that we cannot allow, expenses that were not wholly, exclusively, or necessarily incurred, right? We've seen what? What else should we not allow? Capital expenses of capital nature, right? Provided they are material. Then which one? Domestic expenditure, including your own personal expenditure and expenditure that was incurred on behalf of you by someone, right? Then the third one we have to disallow or not consider as allowable expenditure is what? Expenses which the tax law itself does not allow. So if any tax is paid and you charge it as an expense, remember, tax is charged against tax. Remember that when we talked about tax reductions, right? We said something. We say a tax reduction happens when we take your tax payable. Do you remember? And then we deduct what? And we deduct tax paid from it, tax that you paid or tax credit from it. Do you remember? Do you remember?
Yes.
So
Yes.
tax is charged against tax. So when you see anybody charge tax against his income, you have to take it, add it back so that the tax can be charged against tax because it's considered a tax reduction. So tax is not an allowable expenditure unless under specified cases, like when you are dealing with foreign tax credits under issue of relinquishment. That one, the tax law allows you to treat the foreign tax paid as an allowable deduction under section 112 subsection 3. That's the only case where a tax can be treated as an allowable deduction. If not, tax is supposed to be treated as if the tax is paid by that person. So if it's paid by the company or that sole proprietor, it should be charged against its personal income tax or its corporate tax liability and not in the P&L, right? So if you pay bribe or you incur in corrupt practices, okay, that expense that you incurred, maybe for paying the bribe or you paid some bribe to police officers, or you gave some goods when customs caught you. Those ones, you can't charge it to your account because you could have avoided it. If you pay any interest, penalties, or fines, you could have avoided it. We do not allow. Now, let's say that you have to incur an amount is exempt from tax. Remember, income and expenses go together, right? So if you have exempt income, like when you know that interest from treasury bills, if you're an individual, it's exempt from tax, right? So let's say you incurred some fees for those treasury bills. So far as the treasury bill interest is exempt, then those fees too, you can't charge it as an expense. True or false? Because the income is exempt. So why are you charging its corresponding expense to the financials? Do you get my point, or it's not clear?
Loud and clear.
So any income that is exempt or that is final withholding, any expense in connection with that income should not hit your account because the income itself was exempt or the income didn't hit your account. So why should its corresponding expense also hit your account? It doesn't work like that, right? So retirement contributions are also not allowed, okay? Unless they were included in calculating the employment income of your employees. That is when we allow, right? So retirement contributions are not allowable deductions unless they were used in computing your tier 1, tier 2, tier 3. and you charge it to your account because it's for your employees, then we allow. Dividends are not allowed because they are charged after profits. And then depreciation is also not allowed. This, everything we are looking at is under section 133, right? So we have looked at all the deductions that cannot be allowed for tax purposes. We now have to look at the specified allowable deductions in the Income Tax Act. So in the Income Tax Act, these are particular allowable deductions that we can have. 1, interest incurred by a person in borrowing money for the production of income. 2, financial cost under certain conditions. Trading stock, which is cost of sales, if the person is either manufacturing or selling. Repairs and improvements under certain conditions. Research and development, provided is not included in the cost of an asset. Capital allowances, specific bad debt, provided that we pursue the debt, we couldn't get our money. Rent, provided that all the rent is wholly, exclusively, and necessarily incurred. Advertisement costs when it relates to revenue expenditure and not relating to signboards and signposts that secure benefit more than a year. When you sell assets and you lose, financial costs under certain conditions, I've already mentioned them. Losses from business or investment that can be carried forward. Contribution or donations to a worthwhile cause. Fresh graduate deductions. And finally, realized foreign exchange losses. So if you incur foreign exchange losses, the ones that came with what? Movement of cash. Those ones are allowed by the tax law as a deduction. I hope that is okay. So once we have looked at them, we are going to take them one by one, and I want you to become experts at deducting in taxes. When you know this, trust me, there's no topic relating to personal or corporate tax liabilities that you cannot deal with, okay?